For one brief moment in 2022, Porsche was untouchable. The company posted €6.8 billion in profit, completed the most successful automotive IPO in European history, and held profit margins that every other car manufacturer on Earth studied like a textbook. Ferrari was the only brand on the planet that came close. Then the numbers started moving in the wrong direction. Within 2 years, profits collapsed by 99%. Dealers in China were slashing prices by 35% just to clear dead inventory. The battery partner behind their entire EV roadmap filed for bankruptcy. Factories went quiet. The CEO was replaced. And in earnings calls that spread across the financial press, Porsche's own leadership admitted the business model was broken. Here is what none of the automotive coverage told you. This was not bad luck. This was the consequence of a specific decision made at the exact moment the company felt most invincible. In 2022, at the peak of their power, Porsche looked at the Chinese market, looked at their own heritage, and decided that prestige alone was a strategy. This is the story of what happened next. To understand how badly it went wrong, you have to start with how good it was. In 2022, Porsche was not just a car company. It was a money machine dressed in carbon fibre. The Stuttgart automaker posted €6.8 billion in operating profit, with margins sitting at 18%. For context, Ferrari, the most exclusive brand in the world, was the only manufacturer that even came close. Every other car maker on Earth was studying Porsche's financials like a blueprint, trying to figure out how a company selling fewer than 310,000 cars a year could generate numbers that most mass-market brands would need 10 times the volume to match. Then came the IPO. In September 2022, Porsche AG listed on the Frankfurt Stock Exchange in what became the largest IPO in European automotive history, raising nearly €9.4 billion and valuing the company at roughly €75 billion at launch. Investors were not just buying shares, they were buying a piece of what looked like an unstoppable machine. The stock traded at a premium on day one. Analysts were generous with their targets. The financial press used words like generational and bulletproof. What nobody said out loud, but everyone in Stuttgart almost certainly felt, was that the company had arrived. A century of motorsport history had been converted into the most profitable automotive brand on the planet. The 911 was iconic. The Cayenne was the SUV that saved the company in the 2000s. The Macan was printing money in China. Every product line was performing. Every margin was expanding. There was no visible reason to think any of it would ever stop. That was the problem. The Taycan arrived in 2019, and by the standards of the time, it was genuinely impressive. Porsche had built its first mass-production electric car and refused to make it slow, soft, or apologetic. The car was fast, beautifully designed, and sold immediately. By 2021, Porsche was delivering over 41,000 Taycans a year. For a company that had never made an EV before, that was a legitimate achievement. But a product launch became a strategic declaration. By 2023, Porsche had committed to converting 80% of its lineup to electric vehicles by 2030. The combustion engine, the very thing that had built the brand's identity across 100 years, was being sent toward an early retirement. The Macan would go fully electric. The 718 Boxster and Cayman would go electric. The logic, as presented to investors and the press, was clean. Luxury buyers are already going electric. Porsche has the heritage and the margin to lead that transition, and the company that plants its flag earliest in premium EV territory wins the decade. It sounded airtight. Heritage plus technology plus timing. The Taycan was proof the strategy could work. The IPO funding would accelerate it. The Chinese market, hungry for German prestige, was waiting to absorb it. The assumption underneath all of it was the one nobody stress-tested. The assumption was that Porsche's name alone would be enough to make buyers choose them over a faster, cheaper, and more technically advanced alternative. They never seriously considered that such an alternative might already exist. If you find this kind of financial forensics useful, hit subscribe. Every video goes deeper than the headlines. The strategy looked perfect on paper. The market was about to rewrite every word of it. At its peak, China was responsible for roughly 31% of all Porsche deliveries worldwide. That is not a market. That is a dependency. For most of the 2000s and 10s, Porsche's China story was one of the most impressive growth narratives in the luxury industry. Young, wealthy Chinese professionals were spending on German engineering the way previous generations had spent on Swiss watches. A Porsche in the driveway was a signal. It said something about where you'd arrived. The Cayenne and the Macan drove that story, but the Taycan added a new layer. It told the market that Porsche was not just prestigious, it was also modern. Sales climbed, showrooms expanded, and the company structured its entire production and revenue model around continued Chinese growth. In 2022, at the exact same moment Porsche was completing its IPO and celebrating record profits, China was already absorbing a disproportionate share of what made those records possible. Nobody at the executive level appears to have treated that concentration as a risk requiring serious management. The problem with building your business around a single market is that a single market can change direction faster than any corporation can respond. China was not just Porsche's biggest market. It was a market where the rules of prestige and desire were being rewritten in real time by domestic brands with enormous state support, rapidly improving technology, and price points that made the Taycan look expensive rather than aspirational. Porsche was watching all of this happen from Stuttgart. They were not treating it as the emergency it already was. The Taycan's sales trajectory tells you everything you need to know. In 2021, Porsche delivered 41,296 Taycans globally. The car was praised, the order books were strong, and the brand had successfully positioned itself as a luxury EV contender. By 2025, that number had fallen to 16,339 units. That is a 60% decline from peak volume in 4 years, not because the product got worse, but because the market around it moved faster than the car could keep up with. The range numbers were part of the problem. Early Taycan models delivered real-world range that consistently fell short of rated figures, a damaging issue for a car competing in a market where range efficiency is a basic expectation. Depreciation made things worse. By 2024 and 2025, 3-year-old Taycans were selling for roughly half their original purchase price on the used market. A 2025 study of the used EV market recorded Taycan prices down 26.5% year-over-year, the sharpest model-level drop in the sample. A baseline Tesla Model 3, priced at roughly a third of the Taycan, offered comparable or superior range, over-the-air software updates, and a faster-growing charging network. Chinese buyers doing the comparison were not sentimental about the result. Porsche attempted a mid-cycle refresh in 2025, improving range and charging speeds. It did not move the needle. By then, the problem was not the car. The problem was that the car existed in a market where the competition had already redefined the standard, and the new standard was being set by companies that did not care about Porsche's history at all. The product was failing. The market had already decided it was over, and the dealers were about to find out exactly what that meant for them. The shift in China did not happen gradually. It happened in a burst. Between 2023 and 2025, the Chinese luxury car market went through a rapid and decisive realignment. Brands like BYD, Xiaomi, and Li Auto were not just competing on price, they were competing on software sophistication, interior quality, and the kind of digital native features that younger Chinese buyers treated as standard. When Xiaomi launched its SU7 sedan in March 2024, it received over 50,000 orders in 27 minutes. A car from a phone company, priced well below a Taycan, generating more demand in half an hour than Porsche's flagship EV sold in an entire quarter in China that year. For Chinese buyers who had spent years treating German engineering as the peak of automotive achievement, the psychology shifted quickly. Owning a technologically superior domestic brand, one with software and digital integration years ahead of Stuttgart, was no longer a compromise. It was a preference. Porsche deliveries in China dropped 26% in 2025 alone. That single number cost the company hundreds of millions in revenue and carried implications far beyond the revenue line. It told the market that the brand's grip on Chinese consumers, the grip that had sustained a decade of exceptional margins, was loosening. And once luxury prestige starts to slip in a market as trend-sensitive as China, it tends to accelerate in ways that are very difficult to reverse. Porsche was no longer the aspirational choice, it was becoming the established choice that young buyers were specifically choosing to move past. When luxury brands start discounting, something fundamental breaks. The entire economic logic of a brand like Porsche depends on scarcity and pricing discipline. You do not discount a 911. You do not need to discount a Cayenne. The waiting list is the point. The premium is the point. The moment you start negotiating, you are no longer selling prestige. You are selling a car. By 2024 and into 2025, Porsche dealerships in China were discounting new vehicles by up to 35% just to move inventory that was sitting on lots. On a Taycan priced at the equivalent of $120,000, that is roughly $42,000 coming off the sticker. These were not end-of-year clearance events. This was sustained, structural discounting driven by demand that had simply evaporated. Dealers were caught between their floor plan costs, their unsold inventory, and a manufacturer that had sent too many cars to a market that no longer wanted them at the original price. The dealer revolt that followed was not dramatic in the press, but it was real. Chinese dealership operators who had invested millions in Porsche-branded showrooms were watching the brand's resale floor collapse while the manufacturer kept shipping cars they could not sell at profitable margins. The relationship between Porsche and its China dealer network, once one of the most profitable franchise arrangements in the luxury segment, was breaking down. And the damage was not limited to China. Every discounted sale recorded in Shenzhen or Shanghai eroded the global brand equation. When a Porsche can be bought for 35% below list, the question investors were asking was simple. What exactly is this premium worth? The brand was cracking, and the supply chain collapse nobody saw coming was about to make everything worse. While the sales crisis was playing out in China, the supply chain behind Porsche's electric future was collapsing in Sweden. Northvolt had been positioned as Europe's answer to CATL. The Swedish battery manufacturer raised billions in capital from Volkswagen, Goldman Sachs, and the European Investment Bank, and was supposed to be the foundation of Volkswagen Group's battery independence from Chinese suppliers. Porsche had contracted Northvolt as the sole source of battery cells for the electric 718, the Boxster and Cayman replacements that were supposed to be the next chapter in the brand's sports car legacy. In November 2024, Northvolt filed for Chapter 11 bankruptcy in the United States. By early 2025, it had filed for insolvency in Sweden. The company's debts totaled over $5 billion. The factory in Skellefteå, Sweden, was the only operational plant left. The rest were either under construction, cancelled, or no longer funded. The practical consequences for Porsche were immediate. The electric 718, scheduled for launch in 2025, was pushed to 2027. By early 2026, incoming CEO Michael Lieters was publicly evaluating whether to cancel the program entirely. Porsche had already stopped accepting orders for the gasoline-powered 718 in September 2025, clearing the way for the electric transition. That decision left the company with no entry-level sports car, in a product gap, with no confirmed replacement. Porsche also booked over €700 million in battery-related write-downs tied directly to the Northvolt collapse. Years of development work, hundreds of millions in investment, and the entire product roadmap for one of their most iconic nameplates had been staked on a single supplier that no longer existed. The numbers tell the story of what happened internally. In 2025, Porsche booked €3.9 billion in extraordinary charges, the majority tied to writing down the value of its abandoned electric vehicle strategy. The automotive division's operating profit collapsed 98%, from €5.3 billion to just 90 million. The operating margin fell to 0.3%. For reference, Porsche's IPO prospectus had shown investors a business generating 18% margins. That number had become 0.3% in 3 years. The company was removed from Germany's DAX 40 index after its stock lost more than 30% of its value. By early 2026, shares were sitting approximately 50% below their IPO peak. The leadership change was significant. Oliver Blume, who had served as both Porsche AG CEO and Volkswagen Group CEO through the crisis period, was replaced as Porsche AG's chief executive by Michael Lieters, who joined from McLaren on January 1, 2026. His mandate was clear: cut costs, restore margins, and rebuild the brand's identity around high-margin combustion and hybrid products. His first earnings presentation in March 2026 came with a three-word company direction: leaner, faster, desirable. Meanwhile, the 80% EV target that had defined Porsche's public identity for years was officially abandoned. The electric Macan was staying. The electric Cayenne was being launched. But the broader ambition of converting the majority of the lineup to battery power by the end of the decade was gone. The company that had declared the death of its combustion engine was now betting its recovery on the exact engine it had been trying to retire. One question remained, and the answer was not one Porsche had prepared to give. In March 2026, Porsche CFO Jochen Breckner told analysts the company expected 2025 to be the trough, the low point before recovery. The forecast for 2026 was a revenue range of 35 to 36 billion euros and an operating margin of 5.5 to 7.5%. Goldman Sachs, responding to the same set of numbers, cut its price target for Porsche shares to 40 euros and forecast persistently difficult conditions through 2027. The gap between those two positions is where the company currently sits. What Porsche faces now is not a product problem or a market problem or a supply chain problem in isolation. It is all of them at once. The company spent years dismantling its combustion engine product pipeline in preparation for an electric future, and it is now trying to rebuild that pipeline while absorbing the financial damage from the electric strategy it just wrote off. The gasoline 718 is gone. The electric replacement is delayed, underfunded and possibly cancelled. The Taycan is selling at less than half its peak volume. China, once responsible for 31% of global deliveries, is being rebuilt from a floor of deep discounts and collapsed brand trust. The 3,900 planned job cuts announced in 2025 were extended by a further 2,000 immediate reductions in temporary positions when Litas took over. The restructuring continues. Porsche built the most profitable car brand in history by refusing to be everything to everyone. The tragedy of the last 3 years is that in trying to become the future, they lost the clarity that made them irreplaceable in the first place. Whether new leadership can recover that clarity is the question that will define the next decade. If this gave you a real picture of what is happening inside one of the world's most iconic brands, subscribe and share this video. There is more coming. You do not want to miss what is next.